Hello everyone, and welcome to the Rainey Review for September 2023. After a positive start to 2023, the September quarter delivered something of a shock to the system. Most asset classes delivered a negative return for the quarter. This slide shows the growth of wealth of various asset classes over the 3 months ended September 2023. The leader for this 3 months was New Zealand cash in green, where $1 invested 3 months ago would have grown to $1.01. After that, it's all downhill. In second place is the S&P NZX A-grade corporate bond index, where $1 invested 3 months ago would have fallen to 99 cents. Middle of the pack is that 50-50 mix of shares and property and cash and fixed interest, where $1 invested 3 months ago would have fallen to 98 cents. This slide shows the growth of $1 invested in those same asset classes, this time over 12 months. The leader for 12 months was unhedged international shares in Navy, where $1 invested 12 months ago would have grown to $1.15. In second place, in Australian gold, was Australian shares, where $1 invested 12 months ago would have grown to $1.07. Middle of the pack is that 50-50 mix of shares and property and cash and fixed interest, where $1 invested 12 months ago would have grown to $1.05. 1 year isn't long enough. I always say we need at least 3 years' data. This slide shows the growth of $1 over those same asset classes, this time invested for 3 years. The leader, again, is unhedged international shares in Navy, where $1 invested 3 years ago would have grown to $1.39. In second is Australian shares in Australian gold, where $1 invested 3 years ago would have grown to $1.35. And in third place, in orange, is global infrastructure, where $1 invested 3 years ago would have grown to $1.26. Middle of the pack is that 50-50 mix of shares and property and cash and fixed interest, which would have grown to $1.08. Last quarter, I commented on the passing of a finance giant, Harry Markowitz. This quarter, I'm continuing that theme by talking about Bill Sharpe, who shared a Nobel Prize with Harry Markowitz in 1990. Harry Markowitz's revelation was that risk matters in investing and diversification is the best way to manage it. Sharpe's revelation was about the relationship between risk and return, and how to earn higher returns we have to accept greater risk. Bill Sharpe, in the early 1960s, delivered a seminal paper on the capital asset pricing model, forever known as CAPM thereafter. This relatively simple and elegant equation states that the expected return of any security should equal the risk-free rate plus the market return multiplied by a factor called beta. Essentially, CAPM states that the relationship between risk and return is a positive one. To earn a higher return, you have to accept a greater level of risk. So intuitive that we think it's obvious now, but at the time, this research was groundbreaking. Sharpe expanded on his research on risk with the development of the Sharpe ratio. The Sharpe ratio measures the risk-adjusted excess return of investments relative to the risk-free rate. Effectively, this measures how efficient a return is. This slide shows Sharpe's capital market line and Harry Markowitz's efficient frontier. The ideal market portfolio is found at the point of tangency between the capital market line and the efficient frontier. Investors can then vary the expected return by moving up and down the capital market line, that is, by investing more or less in fixed interest. The combination of Sharpe's capital market line and Markowitz's efficient frontier was the genesis of portfolio construction. The nice thing is you don't actually have to dust off your math to understand Bill Sharpe's key conclusion. If you want to earn higher returns, you have to accept higher risk. But thanks to the work of Bill Sharpe and Harry Markowitz, we can help you construct efficient portfolios for the risk you have to take. Thank you for watching. I look forward to updating you again in the Rainey Review.